Welcome back and hope you're having a very, very good morning. Well, as promised, let's shift focus to the QSR space. From the sidelines at the Kotak Institutional Equities Chasing Growth Conference, my colleague Mangalam caught up with the management of Jubilant FoodWorks and started off by asking about the green shoots in the sector. Let's listen in to a slice of that conversation.
I think for me, there is enough demand that we can capture. We are in a $60 billion food services market. 2/3 is unorganized. Pizza is just $1 billion. So it's always very hard for me to look at a very small category that is eaten thrice in a year by just 50 million customers and say the demand environment is booming or not. What we have worked on is 20-minute delivery, menu innovation, free delivery, making sure that we are present on IRCTC to a Giridih and a Shasharam. Those are the pieces that are working for us, and we see very strong demand and growth based upon the initiatives that we have taken.
So you had said in your post-earnings call that, December's momentum has continued into January. Has that continued into February? And to that extent, in the next couple of quarters, what's the kind of LFL that we can expect?
See, what we are building is the following, right? And we want to build a 5 to 7% LFL business, add 8 to 9% of organic store growth. Together, it is about 13%, and Popeyes adds about 1 to 2 percentage points. So we are building a 15% revenue and 15% EBITDA business. That's kind of the business that we are building. One quarter here and there, I think we are lapping a very high basis. I think was the last quarter we grew 5% on a 12% base, which was, I think, very high number. January was very good, and I think the momentum we'll wait for the March to end around the Holi to.
So 5 to 7% LFL is what something that the street should pencil in going forward on a consistent long-term
consistent basis is what, right? I mean, I want to say that the self-help initiative that we have taken allows us to kind of get to a very. And if you look at last 10-year average, Mangalam, we have grown the company at about 11.5% CAGR in revenue terms. And the simple average of LFL is 5.5%.
Got that.
So I think we've always delivered that.
All right. What about the current trends? If we look at it in the sector, there has been consolidation. Devyani and Sapphire have decided to merge. There has been a new owner that has come in for Restaurant Brands Asia. At the same time, there are a couple of these 15-minute players who've shut shop, citing economic, lack of economic response, so to say. What is the sector doing right now? How is that impacting your performance, or how is that likely to impact what your strategy is?
I think this augurs well for Jubilant FoodWorks. That's what I see. I think my sense is sector was overly beaten because the potential of India, whether I'm not even saying long-term, short-term, medium, the potential is intact. Right? When we open a store in an IIT or an engineering institute or an MBA college, we get massive sales. We are penetrating into Giridih, Shasharam, we get very strong growth. So I think the potential and the reality is there. Consolidation will help, in my opinion, getting more efficiencies, and therefore is good news for consumers. New players coming in, buying into sector is there. My own sense is a lot of competition that came in after COVID, and as aggregators grew, that should consolidate, that should little bit get more sense. And as discounting and other profitability as a marker becomes more important, I see good times for brands like Domino's.
Good times for brands like Domino's. Where does the next 1,000 Domino's stores, how do they pan out? Are you looking at it in cities? Are you looking at it in places which don't have the access to Domino's? Because when one looks at, say, a metro like Mumbai, it seems like the penetration is fairly high. Or when one looks at, say, a tier 3, tier 4 town where there is no access to Domino's, the excitement of a Domino's store opening is fairly high. So how do you balance that?
I think so for us, there are 3 vectors of store growth. First one is cities like I mentioned Giridih and Shasharam, right, where we are the first QSR to enter.
Got it.
For context, we are present in about 510 cities. Maruti dealerships are in about 2,000 plus cities. So with a huge runway to grow in these cities. Second, in existing cities like Jaipur, we only cover 40 to 50% of the city.
Got it.
Right? So these are all green spaces. And third, in existing large metros, take for example Gurgaon. There were 30 stores about 3 years ago. We have now 50. And we think we can add another 20 And in the process, the frequency of pizza eating in Gurgaon has gone up from 3 to 3.5.
Got it. So
Right?
more stores
So
did
more
not
stores,
cannibalize.
more stores actually lead to better experience, hotter pizza, 20 minute. We were together when we launched 20 minute.
Yeah.
If we do it consistently, that drives frequency and higher market share.
All right. And what does that do to your margins then?
Yes, it should improve. I think we are ultimately, I think we'll reduce our expenditure in supply chain, in G&A, faster deployment to technology. So it should ultimately lead to better margins for us.
What's your aspiration here over the next 4 to 5 years? What kind of margin should you be at?
So I think, like I said, we are building a 15% revenue growth and 15% pre-Ind AS margin. That's the company that we want to operate 15-15. And we had already said based on a FY 2024 base, we want to grow 200 basis point in PAT.